Global markets are behaving in a way that feels uncomfortable. Inflation is cooling, interest rate cuts are being discussed, economic data is not collapsing. By traditional logic, this should be a supportive environment for markets. And yet, the markets look nervous. They're not rallying, they're not crashing, they are hesitating. In this video, I want to explain why global markets are nervous despite the good news and why this phase deserves more respect than most investors give it. So most investors expect that markets will be behaving in a simple way. Good news will push the prices higher, bad news will push the prices lower. But real markets don't move on news. They move on expectations versus the reality. Right now, the gap is the source of discomfort. And that is why even positive headlines are failing to create that confidence. The first reason markets are nervous is simple. The good news is not a surprise. Cooling inflation expected, rate cuts being discussed expected, growth slowing but holding up expected. Markets price outcomes before the headlines actually confirm them. So when expected good news finally arrives, markets don't react emotionally. They pause and ask a harder question. What improves from here? When the future does not look clearly better than what is already priced in, markets stop moving. That pause often feels like weakness, but it is really uncertainty. Rate cuts sound positive on the surface. Lower rates reduce the pressure, they support borrowing, and they help in valuations. But markets care more about why rate cuts are happening. Rate cuts driven by strong growth are bullish. Rate cuts driven by slowing momentum are defensive. Right now, markets sense that policy support is coming because growth needs help, not because growth is accelerating. That distinction matters. It creates hesitation instead of celebration. Another important detail most people miss is money is not exiting the markets loudly. It is repositioning itself quietly. So large investors are reducing their exposure to higher risk assets, avoiding illiquid segments, concentrating capital in safer and familiar areas. This kind of behavior does not crash the markets. It drains the confidence slowly. That is why markets feel heavy even without dramatic bad news. Nervous markets are not signals to predict the direction. They are signals to adjust the behavior. So this phase will reward patience over activity, discipline over prediction, and process over emotion. And it will punish overconfidence, forced optimism, unnecessary action. Markets don't need to fall to test the investors. They only need to remain unclear. If you want clear explanations of markets that focus on context, not noise, subscribe to this channel because when markets are nervous, clarity becomes a real edge. Thank you.